has the strength of 3 men and can charge at a speed of 50 kilometers per hour. They usually don't attack investors, but every few years or so, they get aggressive and attack. How often do they attack? What can you do if you're attacked? For your own safety, stick around to find out more. Bull markets can last a long time, but they can't last forever. Eventually, they will give way to bear markets. And it's better to be prepared than overwhelmed when the bear market comes. So, how do you get ready? Statistics. Before we start, I want you to be psychologically prepared. Don't worry, I'm not going to tell you that you need to have the right mindset and other motivational nonsense like that. Instead, I will show you some statistics. The purpose of these statistics is to give you the confidence and conviction to stay true to the winning strategy of having a long-term view of investment. Let us look at how often bear markets come and how long do they last. We will technically define a bear market as a 20% or more dip from the peak. According to Charles Schwab's for financial research going back to the 1960s, the average bull market ran for roughly 6 years and delivered an average cumulative return of 200%. The average bear market, on the other hand, fortunately don't last as long as bull markets. They last just under 1.5 years and produce an average cumulative loss of 39%. The most prolonged bear market was only over 2 years and was followed by a 5-year bull run. You can see from these statistics straight away, you know that if you stay vested for the very long term, the odds are in your favor. Some people who are not psychologically prepared might only go 6 months into the bear market, they become discouraged and abandon investing altogether, thinking that they are not cut out for it. Knowing the average duration and the occurrence of a bear market is very powerful. Again, I repeat, for bear market, the average duration is 1.5 years, the average drawdown is 39%, and the average occurrence is once every 6.5 years. The last bear market we had was in March 2020 when the pandemic struck. Remember, these are not anecdotal evidence without any tangible basis. These are based on 60 years of historical market patterns that repeat time and time again over the decades. I hope from this you have the confidence and conviction to take a long-term view of your investments. So if you find yourself headed into the second year of a bear market, remember chances are that it won't last. Historically, the market's upward movement tends to prevail over the declines long term. But please bear in mind that these statistics came from the S&P 500 and probably only apply to the US market. It may not apply to other markets. Now that you are psychologically prepared, let us discuss the strategies for bear markets. Number 1. Backup cash. Some people panic in the bear market because they don't know whether they have enough cash to handle their near-term goals. Ideally, you won't have to face this question in a crisis because you should have already well prepared for it. If you're retired, having the next 12 months worth of living expense in your bank account or money market fund plus a few more years worth in bonds that mature when you need the money can help you stay calm and clear-headed. You'll behave quite differently than someone who is caught off guard and has never established a backup plan. You may have high risk appetite, but if you haven't structured your assets to withstand a steep decline, you may have to make difficult lifestyle changes if the crisis occurs. So remember to have emergency backup cash with at least 12 months living expense plus a few more years extra in bonds. That will allow you to weather most bear market that averagely lasts 1.5 years. Number 2. Matching goals and cash. Plan ahead of time for what you are saving for, whether it's for immediate expense or long-term financial objectives like college tuition or retirement, or perhaps buying a new home. Create a portfolio that corresponds to your objective. Money you will need in the short term or can't afford to lose, let's say down payment on a house, should be invested into relatively risk-free assets like money market funds, certificates of deposits, or treasury bills. Investment-grade bonds and certificates of deposit should be used to support goals that require funding in the next 3 to 5 years. Only after you have money left over that you won't need in the next 3 to 5 years, Then you can consider putting those into riskier assets with the potential to grow, such as stocks. Number 3. Diversifying your investments. Is there a way to help your portfolio get back on its feet if it's in a bear market? Losses can be mitigated by having a well-diversified portfolio. In any bear market, certain market segments are likely to be impacted worse than others. Because it's impossible to predict these events ahead of time, you need to take precautions today by diversifying within the equities market and across different asset classes. For example, in the 2020 March pandemic recession, airlines and tourism were badly affected, while tech companies flourished. If your portfolio was well diversified across different industries, you would have been well protected and most likely even come out on top after the recession. Take a look at the assets you set aside for medium-term objectives. Besides stocks, diversification also involves having a diverse portfolio of investment-grade bonds, including corporate, treasuries, and perhaps foreign issues. They should also have a range of maturity dates from short to mid-term, so that you always have some bonds maturing and generating income. Your long-term asset should be split across a variety of companies, big and small, fast-growing and dividend-paying, as well as overseas stocks, REITs, and commodities. Or alternatively, you can put it into an ETF with similar diversification. This diverse combination provides you exposure to asset classes that fluctuate independent of each other. Number 4. Catching the market rebounds. Many investors sold at the market lows in March 2009, converting temporary paper losses into permanent wealth-destroying losses. Mutual funds outflow totaled 21.6 billion in that month. Investors who did not return to the market in a timely manner missed the start of one of the most powerful bull markets in history. Timing the market is very difficult. No one knows for sure when the bottom will come or when the recovery will follow. So if you can tolerate it, riding out a bear market may be worth it. Number 5. Having cash on hand. Although cash is one of the lowest returning asset types, don't overlook its long-term potential as a diversifier in your portfolio. Cash has low correlations to other asset types, making it a good hedge against market volatility. Another benefit is that cash reserves might be useful in weak markets. When you have cash, you may buy in when prices are low without having to sell your shares at a loss. As a result, cash can give some stability and flexibility to your portfolio to buy new investments without selling. Agree or disagree with the video? Subscribe, leave a like, and comment down below, and I'll see you in the next video.